Hi, and welcome to this week's Cymex FinTech Weekly Report. Just an overview of what happened last week, what's happening this week, macro outlook, and some charts as well. First of all, our disclaimer. So, trading involves the risk of loss of capital, not suitable for everybody, but of course, hope it is for you. Now, many companies provide leverage, so just be aware you could lose substantially more than your initial investment. The views, opinions contained in this is just purely for educational purposes, try and help you set up for the week ahead. And it does not constitute investment advice, or we're not encouraging you to trade or invest at all. It's got to be your decision. Of course, you should carefully consider the risks, your financial situation, definitely your level of experience and risk appetite. And of course, you should only risk capital that you're prepared, but more importantly, that you can afford to lose. Any doubts whatsoever, please seek independent financial advice before risking your capital. Don't wait until after you've made some losses. Okay, so there was quite a lot that happened last week. Always like to look back first before we look forward. So ECB raised rates by 50 basis points, so they're back to zero, out of negative territory, which is good. You know, again, it was mixed. Some people only thought 25. It had to be 50, otherwise, for me, the euro would have gone through par with the dollar. And of course, we had that sort of new program that they're bringing in, this transmission protection instrument, TPI. All of it is really, it's like an anti-fragmentation. What that means is that if there's a run on someone's bonds within the block, that the ECB will come in and buy those bonds to try and control the yield, stop them from going up too high. There is a certain criteria to meet, and it is at the discretion of the ECB whether they do it. They don't have that obligation. So they've sort of left it a bit vague, a little bit flexible. And I think that's to stop people taking, or countries taking advantage of it, which they could do otherwise. Now, it does mean the end of forward guidance. So what's that? It means that transparency. I covered this actually during the week in my Finaco webinar, that perhaps central banks were too transparent, and it stopped them from being able to backtrack or change policy or not go as aggressive or as fast as they'd previously said they would. So by sort of taking that step back and not saying what they're going to do next, it's benefit for them. Okay, it makes it a little bit more challenging for us as traders, but you know, that's part of the fun of trading, I guess. Now, it's going to be based on a case by case assessment at each meeting. So they will look at the data leading up to that meeting. You know, most of these central bank meetings actually last 2 days, just because the decision comes out on a specific day at a specific time. And of course, note that from the one that's just gone for the ECB, they changed their times as well, so make sure you're aware of that for next time. And therefore that means that they're just going to look at the data that comes out and then make a decision. They're going to look obviously mainly at inflation. Draghi resigned as the Italian Prime Minister. He couldn't keep the backing of the coalition, so there's going to be a new election. Biden's got COVID, and cases continue to increase again. Now, in my daily newsletter that I put out, I mentioned this week I've started to look a little bit more in detail at these cases again. You know, we're in the summer months and yet cases are increasing. So, you know, what is going to happen over winter? And of course, you know, is it going to mutate again? And is this mutate going to remain around the Omicron Or is it going to go back to the delta? Is it going to create a new one? These are all things that, we've got to start being aware of, especially if we're taking those longer term positions. Japan left things unchanged. They will actually put more stimulation into the system if they feel that it needs it. And today there was, Sunday, there was a volcano erupting as well. So again, just bear in mind if you are trading Japanese yen. Now, Russia-Ukraine, obviously still ongoing, although we don't seem to hear so much about it at the moment, actually. Now, they have agreed to allow the exports of grains. Turkey sort of put this together. However, that said, they made the agreement, and then what happened? Russia shelled one of the ports where a lot of the grains would have come from. So we'll have to wait and see whether that gets honoured, and that does happen. I mean, it will be good for the shortage of grains if that is allowed to go ahead, because they've got millions of tons in storage. And Russia this week turned the taps back on, and the gas started flowing back into Europe through the Nord Stream 1. It's running at about 40%. Now, this is important for the European zone to reduce demand now so that they can build up that storage for the winter, because it's too easy for Russia to turn on and off the tap as they feel like it. Techs dropped, so the tech stops, and part of that was because Snap came out, and that was much worse than expected. So their stocks dropped 39%. Twitter's results were disappointing. So overall, the tech stocks dropped about 130 billion. That's pretty much the social media element of it anyway. Crypto sort of had that little bit of a rally, and it got back to the 1 trillion market cap again, which is great to see. Bitcoin touched 24,000, but then it dropped again after Tesla announced that it sold about 75% of its holdings in Bitcoin. And ETH has been rallying just because there's a lot of things going on with ETH at the moment, so that's strengthened up, which again has helped with that valuation of the market cap. And German PMI came out below 50, which is negative. 50 or above is fine. It's not disastrous, but below 50 just means that people are less confident about what's going on with the economy. Okay, so looking forward to this next week. Earnings wise, we've got lots of earnings out this week. So just keep an eye on them. Some of the big companies are starting to provide details there. And then in the US for data, obviously the key is the FOMC this week. Everyone's pretty much pricing in and expecting 75 basis point increase. And then it's just going to be just listen to what's being said about that. Listen to what they're talking about afterwards. Are they going to stick to these projections? So is it going to be another 50 in another quarter before the end of the year? Are they going to start to take a little bit more of a wait and see approach? We'll have to wait till Wednesday evening to find that out. And then other data wise, we're going to see consumer confidence, new home sales, durable goods. So what are durable goods? If you don't know, then that means that the sort of goods that have a lifetime of a minimum of 3 years, so your electrical goods in your kitchen, those types of things, and obviously lots more, but that's durable goods. Then we've got GDP. GDP is just like going for that full health check, except this one's on the economy, includes pretty much every bit of data that comes out. PMI, so what's going on with the purchasing managers? Are they holding inventory? Are they reducing inventory because, again, if they don't want to be left holding a lot of stock if the economy does really turn. Then we've got personal income, production, expenditure. And of course, that's sort of a bit more about the consumer, so that's worth looking at as well. And jobless claims, because jobless claims again last week increased slightly. Now, for me, doubts about the economy going forward, how aggressive the central banks are being putting their rates up and all that. I can see these jobless claims continue to increase a little, not dramatically, but to keep going up for the moment. And I think, where all these jobs are available, where it got to there was 2 jobs available for everyone unemployed in the US, I think you're going to see that start to shrink. I really do. I think that's peaked. I think companies are going to rethink about how many staff they're actually going to take on, and they're going to drop those numbers down. In the UK, we don't have too much out this week, actually. We've got retail sales, basically, and housing prices. And then, of course, the big focus in the UK at the moment is the contest to who's going to be the new Prime Minister between Sunak and Truss. For the EU, again, some data coming out, inflationary data at that, GDP, we've got CPI, consumer confidence. I like consumer confidence. We account for about 70% of an economy. So if we're not confident, then we spend less. If we spend less, that's going to make the economy contract. And then we've got German IFO, German consumer sentiment, their CPI preliminary, and GDP as well. And that's sort of, obviously there's other bits and pieces, but they're the key ones that I'm going to be looking at this week. So macro outlook, I love to look at the fundamentals. It's the fundamentals that drive and determine trends. I love technical analysis as well, but technical analysis just helps with the timing of those entries, those exits, where to place your stops, etc. So the macro outlook, inflation, yes, still high. Although I really, really believe we're starting to see the tops there. In the UK, not necessarily. We may have that one last step to go into double digits. And the reason for that is because of the electricity price cap changing again. I think it's around October. So US 9.1, which was a surprise. UK's 9.4, which is an even bigger surprise. The EU's at 8.6. Food is at 8.9% though. We've still got the potential with the shrinkflation, less goods for the same price. Stagflation, just where you're getting inflation but without any of the benefits. And the potential for recessions, whether that's going to be later the end of this year or sometime next year. And that really is going to depend on how aggressive these central banks remain with these rate increases. Supply chain issues are starting to ease slightly. And, obviously, hopefully China's going to come out of their lockdowns. But that said, if cases are increasing again, are they going to be able to? Because they have this sort of like zero tolerance for them. We'll have to wait and see. It's going to make an interesting leading up to winter anyway. And then Russia, obviously, the invasion of Ukraine is still going on. The fact that Ukraine has applied for EU membership now, if Putin really wants to take over the whole country, he's probably going to speed that process up and become more aggressive, unless he's trying to do it in a different way, because it depends if Ukraine's fast-tracked into the EU or not. But if Ukraine becomes part of the EU wider war still going on, then that is really going to complicate things. Energy and food inflation, yes, it's still there. Now, raw material prices are becoming a little bit lower. I mean, metals have come off. They're pretty much back to where they were at the beginning of the year. Oil's dropped down as well. It's about $95 at the moment. Gas is lower because they've started the Russian pipeline again. Grains are lower, especially with the expectations that some of the exports are going to come out of Russia and Ukraine. But even before that, grains had started to come off a bit anyway. And then on top of that, we've got the pound against the dollar about 120. The euro had a little bit of a spike after ECB, but then dropped back again. So that's about 102.50-ish on Friday. And Bitcoin. So Bitcoin was doing nicely until the Tesla announcement was made. And then it dropped down, but it's still holding quite well. It's still above 20,000. It was over 22,500, in fact. So I think that's okay for the moment. But just remember, it's got that loose correlation to what stocks are doing, and stocks had a reasonable week, so that sort of helped to sort of boost and hold crypto up that little bit higher. Now, we're still seeing that lack of workers, although, I think that there's going to be more people keener to get back to work. I think there's going to be less people changing their jobs soon. They're going to be more trying to hold on to their jobs if things continue to look a little bit more sort of precarious and will start to go into a recession, because obviously we won't know if it's going to be a mild, soft recession or whether it's going to be an aggressive, hard one again. It's always difficult to gauge them at the moment. But, as I said before, just keep an eye on those jobless claims increasing. And I do expect the amount of jobs on offer to drop. Some countries are heading for recession. Timing is going to be everything there for these central banks. US public pensions have had the deepest drop since the Great Recession this year. Obviously, the stock market's down 20% or so. Government bond yields are dropping. That's investors potentially expecting inflation to have topped out, and also maybe that they expect the central banks to slow down their rate increases once they get these early ones out of the way. And the UK has announced it's going to regulate stable coins in their financial services bill. And while we're on the UK, consumer confidence remains at an all-time low. What a surprise. Trading tip of the week. Now, okay, you're watching this, so maybe you're already into trading. Maybe you're watching it to learn about trading. So, what I'm going to sort of just talk about here is how to get started in trading. Obviously there's different ways. You can go the retail way, which most people start off with. So, spread betting, CFDs, but there's also the futures and the options, especially now because, exchanges bring out these micro contracts, so you don't have to put so much risk of your capital into your trades. And then also you've really got to think about what asset class you want to trade: financial, commodity, or digital, crypto, or such like. Now that's really important because you've got to find the asset class and the product that best suits you, your character, your personality, because that is going to have so much input into your trading decisions. And of course, start on a demo account. Take courses. I'm definitely going to recommend them because we hold loads of courses, and you're more than welcome to join ours. We've got some free ones coming up in August, just sort of like little tasters, which you may want to sort of attend between the 9th and 11th. But it's really important to sort of get some skills, definitely get some fundamental understanding of markets and risk management, technical analysis skills, trading techniques, how to create a trading plan, which helps to give you that consistency, trading psychology, how to manage your emotions while you're in your trades. All of that is so important. You think about it, whatever industry you've been in or know people that have gone in the past, they've all had training. Some of them for years. Now, we as pros can always make trading look easy, but it's not. And, it's important that you understand that. And that, whether you've been trading a day, a week, a month, or 2 or 3 years, in reality, you're still a beginner. If you need help, reach out. We're happy to try and give you some advice and help you. Okay, so now we're going to look at some technical analysis. Just a reminder, so black numbers are support and resistance levels, trend lines. Basically, the brown numbers would be breakout levels. The claret numbers, sort of like the red colour, they're the horizontal that are just based on 2 or 3 tops or bottoms that I've identified. And then below with the diagrams there, just little screenshot of the chart. So pivot point colors, so you can see the pivot point colors. The blue one in the middle is the pivot point, and then the ones above are R1 and R2. The ones below are S1 and S2. And to the right, it's a little bit sort of just about see them, but they're the Fibonacci colors again, just to give you an idea. Just don't always put them on; they have to be there for a reason. So, but it's just to give you an idea for the color scheme. Okay, so stocks had a reasonable week last week, and they've certainly sort of come back from this bear trend that everyone was expecting us to go into. Doesn't mean that it's not going to come at some stage, especially if the central banks become too aggressive with rate hikes, but it is a little bit of a wait and see at the moment. So a couple of resistance lines above. There's a trend line coming down, which the market broke through on Friday. But I left it in there because at the moment it's a support line because the market's above it. But if it breaks back down below that at the beginning of next week, then at least it gives you an idea of where the market's going to find its support and resistance. And then there's support lower down. On the 30-minute, so on Friday, the Dow tried to test R1, it failed there, and then came all the way back through the pivot level again, which is pretty much where it sort of closed on Friday. Again, a couple of support and resistance levels there, just horizontal lines for you. The S&P daily, again, sort of, there's a key resistance level higher up, which is the sort of reddish colour. And then, I've managed to sort of see it coming into a little bit of a flag shape at the moment. Whether it's going to stay in that triangle or not, or again, it's just going to wait and see where the market starts the week. FOMC is going to really determine where these markets are going. And a support level lower down as well. As usual, 30-minute. So again, I've got the pivot levels on here because they're sort of quite relevant at the moment, and they're great to trade off pivot levels. Again, almost touched the first resistance level, came down, and actually ended up testing the first support level. So great opportunities there. And didn't quite get to close at the pivot, but it steadied up towards the end of the session. Nasdaq, so again, some couple of major resistance levels above, and then there's 2 or 3. That's another resistance level and a couple of support levels close together below as well. With the Nasdaq 30-minute, here we go. So, again, we got rejected at the R1 and then came all the way down through the S1 and then closed just above it. Managed to identify a support level there as well, which you can see, and that's the number in the black. The Russell 2000, as you would expect, similar to the rest of the stock markets. Here we've got gain resistance levels, 2, 3 of them there, 1 support level for the moment. Just remember the Russell are the small and mid caps. And of course, with the tech stocks, they come under a bit of pressure because of some results from Snapchat, and the rest of the social media's not looking so good. when it comes to revenue from their advertising. Here's the Russell 30-minute. So yeah, again, similar sort of thing. Failed after the data came off, almost tested S2 for the Russell, and then came back and closed just below S1. So the dollar sort of struggled a little bit last week, which makes the pound and the euro look a bit better, but they're not really. But at least they're off the lows for the moment. So as pretty much with all the markets, it's really going to be defined by the FOMC meeting on Wednesday to whether the dollar gains its strength back, puts more pressure on the euro and the pound, or whether it starts to finally weaken. You know, it's highs, strong highs, and you know, quite rightly so in my mind. It should be up there as far as I'm concerned. You know, their economy is still the strongest by far. Okay, so resistance level there for the pound higher up. I've got that channel there for the moment, which gives you the support and the resistance levels. Here's the 30-minute, slightly different channel looking on the 30-minute to the daily. But again, you know, it's sort of range between S1 and R1 for the Friday. The euro, so did find that little bit more support after ECB. It had a bounce and then came back off a little bit again. You know, people aren't convinced with what the ECB is doing. Well, I'm not going to get into it. I preferred it when Draghi was in control of it, or president. He seems to do a good job, actually. So here we are. So we've got a couple of resistance levels, support level lower down. But, you know, again, I've never been a fan of the euro, trading it wise. You know, if I do, it's always from the short side. I'm not going to rush into them. You know, it's so important to get your timing right when you're trading. That doesn't mean you just, okay, I need to sell it now. That's not always the case. Be patient, wait for the right levels. So here's the euro in the 30-minute. So here I've sort of managed where we're coming in for a breakout early part of next week. So let's just wait and see which way that goes. You know, it's sort of round about the 102.50 level. So let's see whether the buyers are confident enough to come back in for the euro. I doubt it personally, but we'll see. Moving on to Bitcoin. So you know, for me, it's a reasonable performance last week. Okay, it come off a little bit from its high in the last 2-3 days, but I think considering Tesla sold out 75% of its holdings, it managed it quite well, really. Again, it's got that loose correlation with the stocks, Nasdaq, so just keep an eye on, you know, Nasdaq, and then they'll give you a little bit of an idea. I've got the chart for the euro, for the Bitcoin Nasdaq coming up soon. So here's the 30-minute chart. So a couple of resistance levels in there, support level much lower down, but let's just hope it can hold. Here's the Bitcoin Nasdaq. So Nasdaq's in the black, Bitcoin's in the red. But as you can see, you can just see that correlation, that loose correlation of how they're following. Obviously, it's the Bitcoin following the stocks rather than the other way around. Moving on to gold. So the gold daily in that downtrend, although it did have a good bounce towards the end of the week, those last couple of days, which was good. As I put in my newsletter the other day, I bought call options, so they're working quite well because I bought them below 1700. And you know, is it cheap? It's going to probably depend a little bit on stocks. It's going to depend on investors' risk on or risk off situation. But it has sort of managed a little bit of a bounce towards the end of last week, as I say. Looking at the 30-minute, again, we're coming in for that breakout situation. Most of Friday it held quite well above the pivot. It tried to break through the R1. It sort of just got through there but couldn't sustain it, and then come back, and then it sort of closed about mid-range. So gold was about 17.25, 26 on the close. And finally, oil. Last but not least, shall we say. So again, here I've managed to identify support and resistance. It's closed around about the $95 mark. Going to have to wait and see what happens there. With the gas flowing again into Europe, it may remove a little bit of the demand for oil as a substitute. For me also, all I'm seeing really is just a change of buyers. The buyers that were buying from Russia are no longer buying from them, but India, China, even Saudi Arabia are actually buying Russian oil because it's discounted, which leaves a hole in the other market. So Europe and the others that don't want to buy from Russia, they can go into that other market and buy it. So really, it's just been that change of who buys from whom, really. Apart from that, I don't really see this big supply shortage that everyone keeps hyping up at the moment. And here's the WTI 30-minute chart. Here, sort of again, we sort of broke on the downside on Friday, and we almost tested S1. But again, we're just going to have to wait and see where that goes for the moment. But things are quite calm. I mean, there's not too much coming out about the Russia-Ukraine war at the moment. So whether that's a good thing or a bad thing, we just have to wait and see. Okay, so that's pretty much it. What I would like to say is thank you very much, and hope you have a great week. Now, just remember, if you need some help with your trading or you'd like more information, we provide a daily newsletter. It's free. It gives you some information. In it, we include sort of global news, my views, chart levels, including the pivot points. So feel free to sign up for that. One-day workshops in August, as I say, we've got some half-day sessions that's to introduce. A couple of them are live in London as well. The ones on the 9th and the 11th are live in London. And then for those that can't make it to London, on the 10th, I'm going to do a couple of online sessions. So feel free to sign up for them. Again, you can just reach out to us at the bottom or myself to find out more details on that. But of course, we do the courses and our sort of amazing masterclasses, which really take you to that next level, regardless of the experience that you have. And you can check those out under the calendar. Trader mentoring, consulting, providing trader education, content to exchanges, brokers. So we do a lot, not just for individuals, but for companies. We advise on hedging for companies as well, stuff like that. But okay, so if you want to contact us, as usual, info@cymaxfintech.com, or if you've got anything that you'd like to ask me directly around trading, then it's chris.tubby@cymax-int.com. Have a great week. Best of luck over FOMC, and hopefully we'll see you next Monday. All the best.